Well, hello and a very warm welcome to this webinar on European Bank Capital, brought to you by Scope Ratings. My name is Keith Mullin, and it's my pleasure to be your moderator for today's session. As ever, there's a lot going on in the European bank capital arena. Banks have come through the SREP cycle. They're facing new capital requirements as we head ever closer to Basel 3.1 implementation. And of course, those requirements could include climate-related capital charges. So are European banks in good shape from a capital perspective? What key challenges lie ahead? To answer those questions and take you through this fascinating topic, I'm delighted to be joined by Pauline Lambert from Scope's FI team. Now, in a moment, Pauline will deliver a short presentation to set some context, and we'll move straight to Q&A. So please do type your questions in as we go along on the questions tab, and we will do our best to answer them. Before I hand over the floor, I just wanted to mention Scope's European Bank Capital Quarterly. The latest edition was published early in February. I commend it to you as a great read, where you can catch up with all the relevant key strands of the capital narrative. The quarterly is available on Scope's website, but for convenience, we'll make it available for download at the end of today's session. So that's it from me. Pauline, hello, great to see you. Let me hand over to you.
Good afternoon, everyone, and thank you, Keith. So yes, as Keith mentioned, I'm going to cover some of the key takeaways from our recently published European Bank Quarterly. We've actually been doing this on a quarterly basis since 2016, so for quite a long time now. The most recent quarterly that we published covered the ECB's latest SREP exercise, the status of Basel 3.1 implementation, and the proposals for a systemic risk buffer to manage climate risk. So before going into these topics, I would like to give a brief overview of our view on banks' capital positions. So we rate about 75 European banking groups, and more than 90% of the outlooks on these ratings are stable. A key supporting factor for the stable outlooks is the sound solvency position of banks. So the higher interest rate environment, as well as contained credit costs, means that banks have been able to bolster their capital generation. This has allowed banks to continue to make distributions to their shareholders, including share buybacks. At the same time, we see that banks still maintain a solid buffer to their requirements. So while the buffer has come down a little bit, it is still above the level that we saw pre-pandemic in 2019. So, and what we do expect going forward is that banks will maintain some excess capacity to absorb the potential regulatory changes that are coming. Moving on to the first topic, which is the ECB's latest SREP exercise, which was completed at the end of last year, where banks received their updated requirements for 2024. Now, there was stability in the overall SREP score, so the risk profile of major European banks, which also meant that their overall capital requirements did not change materially. So if we include the Pillar 2 guidance of 1.3%, total capital requirements increased to 15.5% from 15.1%. There was a slight increase in the Pillar 2 requirement, but the driver of the increase was really due to higher countercyclical capital buffers. So based on a sample of 15 large EU banks, we see that 4 banks saw an increase in their Pillar 2 requirements of more than 20 basis points, while 3 banks saw a decrease in their requirements of less than 10 basis points. So overall, you can see on this chart that there were not major changes in the Pillar 2 requirements for individual banks. But still, we note that there were Pillar 2 add-ons for specific risk, notably the provisioning for non-performing exposures, leverage finance, and excessive leverage. So what it is becoming clear is that the ECB is becoming more insistent about banks meeting their supervisory expectations. And if banks do not meet them, capital add-ons may be imposed. Now, the provisioning matter has been a supervisory focus since 2018, while the issues around leverage finance and excessive leverage have been more recent areas of focus. In the 2022 SREP, we saw that some banks were given a Pillar 2 add-on related to leveraged finance exposures. And with the 2023 SREP, for the first time, we saw add-ons added for leverage, for excessive leverage. So 6 banks received a Pillar 2 requirement add-on to their leverage requirement of 10 basis points. So this sits on top of the minimum 3%. And I think one of the interesting things to note was that actually the ECB disclosed the names of the 6 banks who received this add-on. And several banks, 7 of them, also received a Pillar 2 guidance in regards to excessive leverage. This was on average 37 basis points. And the banks who received this add-on, it was driven by how their leverage ratio performed in a stress scenario. Just as important as the changes to Pillar 2 requirements are the qualitative measures that the ECB imposed. The ECB imposed measures on 103 significant institutions, so on nearly all the banks that they supervise. And as in previous years, the largest number of measures were related to risk and weaknesses around internal governance and credit risk. In regard to credit risk, it was noted that despite the uncertainty and the rising risk from a deterioration in the economic scenario, banks had not changed their cost of risk. And in light of what's happened with financial market conditions, there was also an increase in measures related to liquidity risk. Moving on to the second topic, which is Basel 3.1 implementation. So the good news is that there are the proposals have been published in some jurisdictions, and there is better clarity about the changes that can be expected. And as well, banks have multi-year phase-in periods to actually meet the requirements. However, we do note that across the major jurisdictions, there are some differences in the timelines and the rules, which will make it more challenging for internationally active banks. So the EU is the most advanced, having published its near final proposals at the end of last year, and with implementation to start in January of 2025. The UK has also published part of the text. They intend to publish in 2 policy statements. The first one has been published, and the second is expected to be published in the second quarter, and implementation would start from July 2025. Lastly, we have the US. They concluded their consultation on their proposed amendments at the end of last year, but there has been no agreement yet on the final proposals. And their implementation period would also start from July of 2025. As we can see on the chart, the timeline for when banks need to meet the requirements also varies, from 2028 in the US to 2032 in the EU. And let's see. The last topic I would like to cover is the use of systemic risk buffers. So back in December of last year, the ECB and the European Systemic Risk Board published a report advocating for an approach, quite a holistic approach to addressing the risk of climate change on the EU financial system. Now, their proposal would be to use a systemic risk buffer to increase the loss absorbing capacity of banks, and as well to limit the risk of a buildup, the buildup in risk. So from the report, it is quite clear that they consider a systemic risk buffer to be already quite a viable tool that could be implemented. Now, they discuss various options for the systemic risk buffer. It could be quite a general one that applies to all banks at one extreme, or at the other extreme, it could be a very tailored buffer specific to each bank. And of course, in between, there are options to have a more granular approach by applying a systemic risk buffer, depending on the risk of different risk exposures, or to implement the buffer only when certain thresholds have been reached. In regards to how they would calibrate the buffer, the idea would be to use stress testing. And they actually have carried out an illustrative stress testing exercise where capital requirements would increase by around 60 basis points if a systemic risk buffer was implemented to handle transition risk. So the use of a systemic risk buffer, which is a macroprudential tool, would actually supplement and complement the measures that are already being used by the ECB on a microprudential level. Climate risk is already part of the SREP process. So in the 2022 SREP, we saw that the ECB actually imposed binding qualitative measures on over 30 banks. And a small number of banks actually got a capital add-on to their Pillar 2 requirements due to climate risk. In the 2023 SREP, the ECB noted that a greater number of banks also had a Pillar 2 add-on due to climate risk. So I think in closing, while there are a lot of moving parts in regards to where capital requirements may end up, considering where the banks are starting from, we think that they're in quite a sound and solid position to handle the changes that are coming, especially given the multi-year phasing periods. And with that, I'd like to hand it back to Keith for questions.
Great, thank you very much for that, Pauline. So yeah, I've got a few questions for you already, which I'll read out in a second, but please do type in your questions if you have any, so we can get a good flow going. Pauline, the first question is based on, you talked about the ECB imposing qualitative measures on banks. Now, if you look at Scope's banking outlook and the various country banking reports that your team has published, country banking reports in recent months, they've all stressed that the prudential metrics of EU banks are actually pretty robust. And so bearing in mind that and the fact that ECB has imposed qualitative measures, how do you interpret the ECB's position, and is there any contradiction there?
I don't think there is a contradiction. Because what we saw, for example, from the events in March of last year, is that problems can arise for banks, not because they lack capital, and also that having capital doesn't necessarily solve all problems. So some of the qualitative measures that the ECB has imposed, or things that they point to, for example, in regards to governance risk, one of the weaknesses, apparently, of many banks is that they have difficulties aggregating and reporting risk data. So again, this is something that, maybe slapping on a Pillar 2 capital add-on may not be the most appropriate way of addressing this weakness. Another area that another topic that also received some qualitative measure, or some measure at least from the ECB, was regards to liquidity risk. So in this latest exercise, the ECB imposed a specific currency liquidity coverage ratio buffer. So there was a concern about in a currency, and so not necessarily captured again in capital, but so I think there is a nice and reassuring use of measures, both in terms of imposing capital add-ons, but also other supervisory measures to address the broader risks that a bank may face. Oh, for some reason, oh, Keith, you're on mute.
I'm on mute, sorry.
Yes.
Every time. So in the latest SREP, you mentioned that banks receive Pillar 2 add-ons for legacy NPLs, leverage finance, and excessive leverage. Can you talk briefly about the risks that the ECB sees?
In regards to the provisioning for non-performing exposures, so this is an issue that goes back to 2018. At that time, the ECB was quite concerned about non-performing loans and had a real desire to get banks to appropriately provision and reduce their non-performing loans. And so they set out some supervisory expectations at that time. They expected banks to set aside sufficient provisions to address these non-performing loans. So it's actually been quite a long-running issue. And what we see is that the ECB is becoming more insistent. So I think it was in the 2022 SREP, there were about 25 banks that received the Pillar 2 capital add-on for this risk. And this year, in the latest SREP, the ECB actually, I guess, imposed a higher form of penalty in this regard, because they said that instead of a Pillar 2 capital add-on, we will actually require you to hold additional CET1 capital, against this risk. So they've sort of increased the stakes, because it has been quite a few years now, actually, that banks have been asked to address this issue. In regards to leverage finance, again, that was a more recent supervisory area focused. So other than the fact that, a few banks have been given add-ons for this risk, we don't know so much about it, but clearly in a weaker economic environment, highly leveraged companies, that is a risk. I think this year's topic of leverage finance. So here, or not leverage finance, but excessive leverage. Here, the ECB is looking at, banks who have an excessive use of derivatives or securities financing transactions. And I think also interestingly, they mentioned regulatory arbitrage. So when banks report their leverage ratios, is there window dressing happening? At the numbers at the end of the quarter, what do they show compared to the rest of the year? So again, these are things that, they're trying to address. And we see that, for example, in the UK, some of the banks are now also required to report average leverage ratio figures. So not just spot rate, but also, something that reflects what the leverage ratio has been throughout the quarter.
Yeah. Okay. You also talked about the Basel 3.1 implementation differences between the US, UK, and EU, and you had that very useful timeline chart. But beyond that, are the expected differences or impact, should I say, really so different, and why?
I think, of course, we've given some headline numbers. I mean, in the public domain, the headline numbers are, that the impact on UK banks will be about 3%. The EU around 9%, and in the US 16%. So that certainly does seem like a wide range. But if we look at the figures more closely for the EU, we see that the GSIBs actually are expected to have an impact of closer to 15%, so quite a bit higher, while smaller banks, will have a much smaller increase, of around 4% increase in their requirements. In the US, the 16% really refers to the largest banks, sort of the GSIBs in the US. And I think in the UK, if we look at some of the GSIBs there, like the Barclays or the HSBC, their requirements on the whole are a little bit higher already. So their Pillar 2 requirements, for example, for Barclays is in excess of 4%, while across the EU, we're looking at Pillar 2 requirements of closer to 2%. So I think, and based on the indications that the banks have been giving us, there is an indication that Basel III implementation will increase the risk-weighted assets from sort of 5 to 10%. And in some of those numbers, there are also other regulatory changes that are incorporated, not just Basel III. So, I think it still seems to be quite a manageable level for the banks to absorb.
Okay, thanks. There are a couple of questions one about output floors and private equity and NPL in Basel 3.1. I'll ask a question, but perhaps you read the question so you can ponder potentially the answers or whether we have to circle back. But just on that question that you just answered, do you think there's a risk that different regulators could diverge too much around Basel III implementation?
I mean, it is certainly, I guess, a challenge for internationally active banks. But I think at the same time, we have to remember that supervisors operate in a global environment. Certainly, the supervisors were all part of the discussions around Basel III. and provided input into the process. So, and I think at the same time, they're also conscious that, they want a level playing field, so for banks that are active in many jurisdictions, it doesn't make a lot of sense to have very varying requirements. It makes it more difficult, potentially a market less competitive for banks to operate in. So I think that will be one area that will, sort of stem the divergence. And also at the moment, we see that the US proposal is potentially the most dramatic, but that's sort of in response to the bank, what happened in March of last year, where they suddenly saw that some of the regional banks had issues. So some of the reforms that are being proposed there are really meant to address that issue, to sort of expand the supervisory framework to regional banks, which may be actually relatively large, because currently the US system is very focused on the GSIBs and the very large banks. I guess that would be my response to this. Oh, you're on mute again, Keith.
I'm having real connectivity issues, so that's why I keep going just to try and rectify it. But there's a question about whether banks are well prepared for the Basel output floors and whether banks need to build up capital still to take that into account. Is that something you can answer, or would you prefer to circle back?
I'm sorry, Keith, I didn't quite get this. Yes. Was it just that in terms of are banks prepared for the output floor?
Yes.
Yes.
Or whether
okay.
they still need to build up capital.
Right. Yes. Well, I think, if we look at the latest studies from the EBA, for example, it does show that the gap to meeting these requirements has shrunk dramatically, and there is not much of a capital gap. And I think this is due to the fact that, banks already have been preparing for Basel 3.1, and the supervisors have been, making changes to internal models and so on. And as well, the implementation period goes out to 2032. So quite a long time for banks to address this. So at this point, I don't think, it's going to be a huge effort for the banks.
Yeah, okay. And do you think, how are investments in private equity assets and NPLs, such as securitizations, treated in Basel 3.1? That's quite a specific question. But
yes, and I don't think I'm on top of that enough to provide an answer, unfortunately. Yes. Okay.
All right, that's fine. Okay. Yeah. Now, climate risk is perhaps the big topic of the day, well, of the decade, really, I suppose. And there's a question about banks' disclosures, which is given that banks' disclosures on exposure to climate risk are not complete, and you did talk about this, can macroprudential measures such as a systemic risk buffer be used effectively? Can you just recast your thoughts that you made during the presentation?
Yes, I think that is quite an interesting question. Based actually on the report that was published, there was an acknowledgement that the current classifications for exposures, the industry exposures, are not quite granular enough. So there could be an issue depending on how the systemic risk buffer is calibrated and designed. At the same time, I think that it's work in progress. So, again, we expect better disclosures from corporates, the clients of banks. So this should improve. But it does propose a challenge. And I think the other thing that the ECB and the ESRB recognize is that the exposure is not the same across all banks. So I think they would be a little bit hesitant to use a very blunt tool, to assign quite a hefty systemic risk buffer across all banks, because it actually may not be the same issue for all banks, that, depending on a bank's exposures and so on, the buffer may and should vary.
Yeah, absolutely. Can you, I mean, so that's perhaps a broad question, but what are the ECB's expectations for banks on climate? I mean, do you have sort of a quick and easy answer to that?
Let's see. Well, I think in 2020, the expectations were published. And I have to say, I'm not envious of banks who had to meet those expectations, because there were 13 expectations covering a variety of topics. But I think the things to note were that they expect banks to be able to understand how climate and environmental risk will impact their business. So, and they also, expect banks to consider a timeline of in the short term, the medium term, and the long term. So it's quite a far-reaching mandate that the banks have, that they have to incorporate this into their business, into their risk management, into their governance. So all aspects, how could it impact credit risk, market risk, liquidity risk, operational risk, and at the same time be able to report on their exposures, and also to make for internal reporting purposes, but also for regulatory and public disclosures. So, yes.
Yeah. Okay, and Pauline, there's a question which it's an interesting one, which has just come in, which is: do you think we're at the end of the regulatory journey? I guess the obvious answer is potentially no, given the iterative nature of regulation. Yes. But the question is thinking about liquidity framework, AT1s, interest rate risk. Yes. I'm assuming that that they'll carry on iterating to suit.
Yes. Well, certainly the priority in the short term is Basel 3.1. I mean, this is the big project that still needs to be pushed through, and that needs to be implemented. So I think there's going to be focus on this first. We've got this big project that they're working on, and the idea is really to get this done. But at the same time, I think supervisors are very conscious that the operating environment is changing. So they have to think about, have new risks emerged? Are the rules in place sufficient, appropriate? Do they work well together? Are there double counting of requirements? I think they're constantly going to be evaluating where the regulatory framework is, and to see if it's still appropriate. So I don't think we can say that, we're probably at the end of the process. I think we are coming closer to Basel 3.1 implementation. But as we know, new risk will arise and emerge, and regulators will want to be on top of that.
Indeed, which is why we're up to Basel 3, having been through Basel 2 and Basel 1. But just to go take us out there, the general outlook, Scope's general outlook is that the European banking sector is in reasonably good shape. Notwithstanding, there are some headwinds out there, but the general sector perspective is a positive one. Is that fair to say?
Yes. I would say this is the case. We do see some risk, probably to profitability in the near and medium term, but at the same time, and also to asset quality. But I think the pace at which these risks will emerge and come about are going to be manageable for the banks, considering their very sound starting positions.
Yeah. Okay. Yeah, I think Pauline's video has been disabled. I think because of connectivity issues or bandwidth. So I'm not sure we can still hear us, Pauline, but if you can, then I think that we've come to the end of our questions. And so apologies for the connectivity here and the bandwidth problems that I think I've been having, and others. Hope that you heard what we had to say, though. Now, I mentioned at the beginning that we have the Bank Capital Quarterly and today's slides available for download. And so if you, at the bottom of the screen, click on Apps, and then you can click on Handouts, and both PDFs, the Capital Quarterly and the slides, are available for you to download. So whilst you do that, I wanted to once again thank you for watching and staying till the end. Thank you in particular to Pauline for putting together some very insightful thoughts and answering the questions. And we will be back soon with an update on this as appropriate, and hopefully I think we'll be back later this year with another banking outlook. So without further ado, thanks a lot. I wish you a very successful rest of the afternoon, and we'll see you next time. Okay, so it's goodbye from us.
Thank you.